It's been an incredible earnings season, particularly in the US, but also in Europe. A lot of it is being driven by top-line growth that's allowing margin expansion as well. And so this is just a pretty unprecedented growth era. And in fact, it's not even necessarily grind higher. Parts of the market like the Nasdaq, which are not yet at highs, are actually looking outright cheap considering the scale of sales growth that they are generating. It's really astonishing.
An unprecedented growth era.
Yeah.
What does you mentioned the Nasdaq? Do you want to lean into that? What's being overlooked right now?
Well, sure. So certainly the technology names in the Nasdaq were very well held alongside things in Korea, the AI trade. But really what we saw for a month or so was de-risking into summer and a lot of volatility in single stocks, both of which cause further de-risking. And so winners got sold and losers got bought. That appears to now be over. And as people come back from holiday, I just expect they're going to take advantage of that and lean back into the same trades, particularly because if you look at the average of single stock volatility, it was north of 50%, like really unprecedented highs, not just outright, but also relative to the index. And since earnings season has sort of given everyone a bit of reassurance that the AI trade is still growing very strongly, that volatility has dropped down into the mid-30s. So all of the VAR calculations in any fund using leverage is basically saying you can add a lot more leverage if you like.
So it feels like this is just the tide going in and the tide going out, and just in terms of the leverage that's being added at the moment.
Certainly in the last month or so,
That's what this market feels like at the moment. But you suggest the fundamentals are there.
The fundamentals are more than there. So the concern that I think was an ex-post narrative as to why the market was falling was that there was too much spending, too much capex.
Yep.
That's, in our view, not remotely true. Keith Parker has rejoined UBS. He's published his big launch piece. And one of the key focuses on that was that capex has grown to $650 billion. That's up from about $300 billion a year ago. The backlog of cloud revenue that is going to be generated based on data center growth is up $1 trillion over the same period to $2.4 trillion. So you've got $2.4 trillion, which is 100% of existing cloud revenue that's going to get booked into realized revenue over the next 2, 3, 4 years. Google said that they think they're going to monetize about half of their cloud backlog within 2 years. So the revenue growth within cloud businesses, growing because everybody wants to get their data onto platforms to make use of AI, is absolutely astonishing. And it's causing massive sales growth, which has not been priced more cheaply since 2011.